Writing an angel check is easy. Knowing why is the flex. Angel investing. Underused, misunderstood, explained badly. Angels Decoded, an educated and raw take. In cahoots with Play Money. So I got a text from a founder earlier this week. Her SPV is up on Play Money, and she got invited to pitch to an angel group that I knew well. And she asked if she should keep her round open longer to accommodate their diligence process. And I told her no.
There's two paths here, and I want to sketch out what we're talking about. There's the path of keep it open, as much money in, and just you're open, so you may as well just keep rolling with it, versus having a plan, having a target, opening it, closing it, getting back into what you're doing. And for me, polarizing ends of the scale, but ultimately they're really your two lanes on an angel.
Yes. And the reason I told her not to keep it open for several more weeks and go through this angel group's pitch process and their diligence process and everything else is because I've seen their track record in the past. And they are a group that over-diligences for the size of the check they write. And I like that for the founder's choice, they had better things that they should be doing with their time.
And it's always the unknown. If you get to a point where someone says yes and they start the diligence process, if you're a first-time founder going through that for the first time, it's easy to get excited about that, but you don't know who you're dealing with, and you don't know how serious they're going to take it. And by serious, what I mean is, are they going to be completely OTT and be a thorn in your side just to get it to a point where you get money in the bank?
I think it's goes even beyond that. The reason I told this founder not to waste her time is because this is a group that does too much diligence of their own, but also doesn't then show up with the check. Like I've seen this group put, $5,000, $2,000, $20,000 into a startup. And then you're talking about like the time value of your money as a founder at that point. Like the diligence and the check didn't match up.
And you need to be aware of that. And this is as much for the founder it is for the angel. Stepping back and thinking about what stage the business is at, the role that you're providing as an angel investor for capital. And it should be frictionless to a certain degree. That's the whole intention of angel investing, assuming you're on a safe note, none of that other weird ways of doing contracts. But safe note, angel investing, it's designed to be turnkey for a reason.
Everyone, it's so interesting because when you start angel, there's all these classes you can take to teach you how to do diligence. And diligence is important, but that doesn't mean you have to do it. And the diligence you should do really should map to the size of the check you're writing. If you're writing, a $200,000 check, there's a certain amount of diligence you need to do. If you're writing a $2,500, you're taking up a lot of that founder time, not so good, right? You're distracting from the business that you want to invest in the founder to build.
Particularly at that early stage as well, where time is everything. They don't have depth of resource and time to try and nurture that investment like a series B or C, right? It's a very different conversation. So within that, from a practical perspective, and again, relevant for angels and for founders, typically you have a data room of sorts. And in that early stage, you don't have a lot of data, to be honest. Like if you're even pre-revenue, pre-launch, there's not a lot to share. So in that, where does the burden lie? Should a founder have obviously foundational documents, charter, all the things that they would have, but to get to the point which is money in the bank and back to business as usual situation, where does the burden lie on what the founder creates versus how much diligence the investor does?
Right. Well, I think we should separate two things. Like there's an element of good hygiene due diligence, and it's all those basic documents. It's the cap table, it's the incorporation. Those should be in a data room. And typically there is some, at least when a deal gets to Play Money, there's some level of professional investor in the deal that has gone through those documents and chosen to invest because it's a clean, well-lit space. A professional investor knows how to look through those and do that level of understanding. An everyday angel doesn't. And frankly, they shouldn't. You can proxy that trust onto someone else that they've looked at them, particularly when you're the kind of angel that could look at all those documents and not know what they mean anyways, right? What's a good cap table or a bad cap table? What's the red flag you're looking for? if you're writing a smaller check that's in the 4 figures or maybe even the low 5 figures, like a founder shouldn't have to spend the time to take you through that. You've got to trust someone that came before you on that.
And I'll put this in show notes. We had a previous episode where we talked about that from a stage-specific capacity. What are the things that you're looking for? Because it's actually a bigger conversation, right? We talk a lot about the putting minimum 30 bets down. It goes back to what are you actually doing? Why are you doing it? If you're supporting an industry that you're passionate about, there's a
Right.
founder that you meet that you want to support on their journey. But there's a lot of other reasons that a VC may not look for about why you're showing up to start with. And the strategy is breadth. It's not interrogating some poor early stage founder, getting them down to a point where you're trying to break them, because that doesn't help anyone.
No, it doesn't. When you go in, though, to talk to a founder, especially in an early stage investment, like I think there's 2 bundles of things you need to dig into and want to dig into. I mean, the first is like understanding how that founder is wired, right? In early stage bet, it's predominantly about the founder and the team they've built. And, is this the right team that's hungry enough and dedicated enough and crafty enough and has shown an ability to execute and understand what they have to do next? And you should absolutely spend the time with the founder and team to understand that, because that's at the crux of what should be making you say yes or no to that investment. If you're investing, $250,000, you should spend a little more time with them. If you're writing a $5,000 check, you shouldn't need any more than a half hour with them. But you're really trying to develop your spidey sense on the team at that point, and you can only get that from the team. The other piece of diligence is around the business and the industry. And I see that this is the place where good angels and bad angels separate themselves, when good angel groups and bad angel groups separate themselves, and how they do that kind of diligence and how much time they take and whose time they take up to do it. That's the place where it's like make or break.
Really interesting, because human instinct is to want to make sure you're getting all the facts right. Like, you don't want to be getting into business with someone that has a really dubious, like, say, criminal record. There's really basic things in there that you're doing. But if you start opening that can of worms, then you go into a slippery slope of becoming a private detective.
Wow, you took that in a whole direction I didn't see coming. I was like, when you are angel investing, you're either, sometimes you start out investing in founders already or industries already. But to build that more robust portfolio, you have to move outside of that realm. So you have to find deals in clean, well-lit places where someone else has done that background check, or you can trust someone else to have done that. Because if every individual angel has done that, or if you insist on doing that as an individual angel, you are going to have a worse problem coming your way, which is founders aren't going to want to work with you. So you're only going to see, what I call the thirstiest founders. It's an adverse selection problem. And that problem's going to exist whether you're an individual angel or an angel group, right? An angel group, I told this founder not to wait out for this angel group because I knew they were going to do several hours of diligence where she had to be involved. And then I knew they were going to be slow on it, to schedule it slowly. So it would probably take another month. And I knew on the tail end of that of like, if she got even $25,000 from this group, it would be a huge win. Like, that group is going to start seeing less good and less good deals because me telling this founder that, another founder is going to tell another founder that, and then they're going to tell a different founder that. And all of a sudden there's a reputation that builds on this group. They look great on the surface, and that matters.
Important. And my statement was slightly loaded.
The one about founders going to jail, that was a little loaded. I was like, I don't know where you're going with that.
It's intended to get from you what we needed to hear, right? I'm being dramatic because as an angel investor, you need to get outside of your own head because it's different to what you think. So you've covered that beautifully there. So to be a good angel investor or angel group, can you talk me through someone that does that well, that that is buttoned up, they're effective, and they generally want to help founders on their way?
There's a group I like, I'm not going to name any names on this call, that I think does a really great job with their diligence. They have a lead committee that spends some initial time with the founder and sussing the founder out to make sure they feel like a quality founder. And then they do a bunch of diligence offline, diligence on the market, diligence on, the customer's, diligence on the founder's background. And they do that without taking up the founder's time, right? They could sit the founder down and quiz them on all these things, but they're like, you know what? Nope, we're going to step back. We're going to let you run your business. We're going to do this level of diligence. They talk to that founder's other investors so that they have an understanding of the business. Then they take that information and socialize it with the people in their angel group who have expertise in the area. So again, they're developing their own set of questions and knowledge on their own time. So then when the founder comes in to present again and have a deeper discussion, the diligence goes like 3 clicks down. It's not the 101 of the industry. It's really diligence designed to understand how the founder thinks. What they understand is the shape of their business. What earned insight have they had on their journey that someone that even knows the industry really well might not see? So the diligence time that actually uses up the founder's time is true value add. And to see a group do that efficiently and well just feels like such a sign of respect for the founder. And frequently, if you talk to founders that have gone through that kind of diligence, like they feel like not only were they respected, but they learned something new.
So good, because a lot of that stage of investing is repetitive and consistent, right? There's nothing, there's no real outlier there of information you need to find unless there's a use case in an industry that is completely random. And for me, I find that fascinating. So if you want to build your diligence muscle, you're going to work out and you want to write a lot of checks, what's the move? What's the thing you need to think about so you can be repetitious and effective with your time and the founder's time?
I mean, honestly, I think it's Cyan Bannister, who's a famous investor and a really good one, talked about this the other day in something I read. I think what you've got to do is there's certain places where you may source your own deal because you know founders deeply, you know an industry deeply, and you're going to get a few of your investments from that. But everything else, you're going to have to go out to a network. So really what you're doing as an angel is learning who you can trust to be a proxy for some of that work. Who do you think has a good pipeline funnel going in? Who do you trust to go do that good hygiene diligence? Who do you trust on point of view of like, hey, this is a quality founder, so I as an angel can, see them pitch on video or have a 15 or 20 minute conversation in them to validate for myself, but I'm trusting the work someone else has done before me. So instead of like only vetting founders, you're vetting trusted sources of deal flow and proxying through those.
Great advice. And again, it's fascinating for me. And I quite often hear things like that. And I'm like, I wish I'd met Cheryl 3 years ago before I started writing my angel checks, because I could have learned a lot from you. And as a friend, of course, but
I was like, of course you wanted to know me before that.
In all seriousness, though, that is really good advice. So we're trying to overcome here rookie mistakes in the diligence process that Angel makes. What would you leave angel investors with? What's the thing that they should take away from this episode?
They should take away is right size your diligence to the size of your check. The best thing you can do for a founder is make sure they have the most amount of time to build their business and respect that. And if you do that, you will be a angel that gets access to the best quality deals. Over-diligencing is a negative signal and will actually probably negatively impact your returns.
Cheryl Kellond from Play Money. I am Andy Walsh from Startups Decoded. This is the time of the week where we get together and have a good chat, but you should walk away listening, because ultimately what we're trying to do here is bring in more angel investors, build a community, drive a really buoyant early stage capital market, and we're excited to keep sharing this knowledge.
I love it. You got to love when doing less diligence is like the more better thing. Work less.
Yeah, exactly. Work less, invest more. Everyone wins.
Happy Friday. I love it.
Happy Friday. Thank you, Cheryl Kellond.
Thank you. Bye now.
Angels Decoded, a weekly podcast for people learning the craft. Angel investing made easy. Subscribe, then decide. Angels Decoded, in cahoots with Play Money.